Hi all, today is the first in a series of webinars looking at order flow. Whether you're brand new to order flow, struggling with order flow, or have been using it for a while, we have something for you today. For those that don't know, order flow analysis studies the factors that both cause and prevent price movement. As we go through these webinars, we'll take a look at market behaviours you can observe yourself. You can then start taking advantage of behaviours you feel are beneficial and stay away from behaviours that aren't. And this is important because many aspiring traders think that the learning process should involve being told what to do. Don't tell me the theory, just tell me where to get in and where to get out, they say. Retail traders gather information on trading from various locations, some paid for and some free. And some of the things they learn become beliefs, things that make sense and sound clever. Things that come from believable speakers, from sources they feel they can trust. Now these things are just beliefs until you can actually make money from them. You might have faith in them, but they become fact at the point you're using them to make money. And it's clear that some people are going to hold beliefs about trading that are nonsense. You've probably seen people like that online. Now if you think about the best trading speaker you know, the most credible person you've come across, how much money are you making right now from what they taught you? How much money do you know without doubt that other people are making from what they taught? And for most people, the answer to both those questions is going to be zero, because beliefs will only get you so far. Your own observations are what will get you to the level where you can risk real money. Now, so far this year, I've sadly met two unprofitable traders that have both been trying to trade for 20 years. Now think about that. In both cases, they'd been moving from one belief system to another. They never really went through a rational period of observation with some kind of logging that would give them feedback. They mostly tried to just do what they'd been told. Now, if you look at how proprietary trading firms teach their interns, they of course do give theory. But the main focus is on getting traders to see things for themselves, which would be kind of guided observation. Now, as I was putting these slides together, I contacted a friend that runs a prop firm. And I asked him what was the split between giving theory and getting the interns to see things from themselves in their own training program. And it turns out the theory part of their program is about 25% of their entire educational program. Now, an example here might help highlight how important this is. So let's say that I told you that this circle here and the white area that precedes it combined were often seen at reversal points. Now, I'm not going to explain why at this point because it's not really important. Now, given that information alone, the belief-based trader would trade each of these circles as a reversal and most likely lose money. After all, we have 5 circles and we can clearly see that some are not occurring where there's a reversal. So the belief trader wants to be told what to do, doesn't really want to look into it any further. But the observant trader will watch this play out and add more depth to it. So for example, they may look at, what percentage of times do the circles create reversals? Are there market conditions that make the reversal more likely? If I let the market reverse a little first, does that make it a better opportunity? How much risk do I need to take? Now, the reversal could be just a 25% probability, but if I could risk 5 ticks to make 30, then it's going to be worth a look. And it doesn't end at observation either. In fact, once you start trading something, you need to perfect your ability at executing that trade. In other words, you then need to build the skill at that trade. And that's why in this series, we'll look at things you can observe and we'll guide you through the observation process. At the end of the day, when you're trading, it's you that has to decide when to get in and when to get out. And there is no shortcut to that. And hopefully those in their 20th year of taking this shortcut will start to take note. Now, many people in the trading world describe the markets as an auction. You hear terms like the market is auctioning up. But what does that actually mean? Why not just say the market is moving up? If you take a new trader and tell him for the first time, look, my friend, the market is an auction. Will that trader then turn around and say, Now I understand perfectly where to enter and exit my trades. Well, probably not. Now if we look in the dictionary, an auction is a publicly held sale at which property or goods are sold to the highest bidder. In traditional auctions, people are bidding against each other for an item. Price only goes up one way, up, once bidding commences. There are also reverse auctions or Dutch auctions where competitors bid lower prices to win business. Now in both of those types of auction, we have two sides and price moving one way once a first bid has been accepted. In addition, the participants are on one side or the other. So if you take an item to sell at an auction, you don't end up buying that item. So the term auction doesn't seem to fit that well with what's going on in financial markets. So for now, let's put the term to one side so we don't get confused between real life auctions and what's happening in the markets. Now don't get me wrong, I am not knocking the details of auction market theory, the great stuff from James Dalton. It is a good way to look at the market. Just that the term auction is way overused and not very helpful. And neither is claiming that the market is auctioning up. It's just simply a smart sounding buzz phrase for moving up, which provides no additional clarity or actionable information. So let's put the auction model to one side and let's think about the forces that impact price and how those forces interact. Something that has practical use. Now, financial markets are four-way markets. In other words, there are four forces at play that impact overall direction. And these forces are buy limit orders or bids, which we call a weak up force. Sell limit orders, offers and asks, the weak down force. Buy market orders, we call buys, strong up force. And sell market orders, sells, strong down first. Now the first question that comes to mind is, well, where are the stop orders? Now stop orders are important, but they aren't an individual force. And that's because stop orders are simply market orders that get created when something happens. A stop order is simply an instruction to create a market order. Now unlike a regular auction, speculators will switch from being one force to another. To get into and out of the market, you first buy and then sell, or vice versa. So you are participating as two different forces at two different times over the duration of a day. And it's quite common in one day to participate as all four forces throughout your various trades. Now we have four forces, but it is actually a little bit simpler than that because we only have two possible interactions between those forces. So just two ways the four forces can work together. So we have an interaction up between buy market orders, and sell limit orders, and we call that a buy. And we have an interaction down, sell market orders and buy limit orders, and we call that a sell. Now if all interactions have a buy on one side and a sell on the other, then that would seem like a neutral event. And if these interactions were neutral, then price wouldn't move. Now they aren't neutral because we have strong forces reacting with weak forces, and that's where liquidity consumption comes in. Now the term liquidity is one that confuses a lot of traders. So let's explain before we continue. Liquidity simply refers to the availability of the other side to trade with. So a liquid market is one that's easy to get into and out of, as there's always someone on the other side to trade with when you want to exit or enter. Now if we consider the two possible interactions, it's the limit orders, the weak forces, that are considered to be the other side. So limit orders are the liquidity. It's as simple as that. And in every trade you take, you'll either be providing liquidity by trading with a limit order or consuming liquidity by trading with a market order. And it's that process of consumption of liquidity that is key to price movement. Now in this image, we have the strong up force, the market buyer in green here, consuming the weak down force, the sell limit orders, which are the red dots. The market buyer will consume all liquidity at one price before they can move up to the next price and consume the liquidity at that price. Now you'll notice there's no liquidity beneath. That's because they've eaten it. And that's why on the sell side, liquidity only exists above us. If we look at the other interaction, strong down force consuming weak up force, that's sell market orders consuming buy limit orders, we have the opposite occurring. So sell market orders consume buy limit orders. When the buy limit orders have been consumed at a level, price moves down and we eat the limit orders at the next price down. There are no buy limit orders above us as they've already been eaten. And we wouldn't be at these prices if we hadn't eaten all the buy limit orders above us. We'd be somewhere higher up. Now we have strong and weak forces, and we can also consider them to be moving forces and stopping forces. So a moving force, movement in the markets, comes from market orders. That's your moving force. So like our Pac-Man, they move through the limit orders, consuming those limit orders as they go. If there's no market orders, there is no movement. Now the stopping force is the limit orders, because the limit orders might not create movement, but they do stop it sometimes. So sometimes in this case, there's just too much liquidity to eat. So often the limit orders are kind of hidden, and more contracts, we can see we're adding more contracts here, are added as market orders attempt to eat them. And that's something known as an iceberg order. So when sell market orders can no longer eat the buy side liquidity at a level, price stops moving down. Not only that, many of these guys that sold with market orders, they're now stuck, having shorted contracts only to find prices no longer moving their way. Now the balance of trade, the volume of buy market orders versus the volume of sell market orders, is a key metric in order flow analysis, but it's not enough just to analyze the strong or the moving forces on their own. These stopping force events are a little bit more nuanced to read, but they are equally important. So in the above image, the buy limit orders became a stronger stopping force and they just became too big to eat. Now sometimes the stopping force is evident on the depth or market or dome, but a lot of the time it's hidden, and you only get to see how much liquidity is really there by how much eating occurs. Now we also have something called the spread. Now we've seen that there are two strong or moving forces, one up and one down, and those are totally independent, right? There is no relationship between these two guys. But there's still a missing piece, and before we cover that missing piece, let's consider how these two interactions work together. So we have bids and offers. So here are the bids, here are the offers. And they get eaten by sell and buy market orders. So the limit orders are a potential stopping force, but most of the time that force is too weak to stop the market. But sometimes it's strong enough to stop price from moving. Now the term inside bid and inside offer simply refer to the bid and offer prices that have to be eaten next. Okay, so the highest bid and the lowest offer. Now the difference between the inside bid and the inside offer is what's known as a spread, something most of you will probably know. So what is the missing piece? Well, if this is a true representation of what's going in the market, why don't we see the distance between the offers and the bids increasing as trade continues? Why don't we see this wide spread? So think about it. What we've discussed so far is two interactions with no relationship between them. Yet we take for granted that the bids and offers tend to move up and down together, but they're not related at all. The interaction up is completely independent of the interaction down. So why is it that we don't see the up and down forces moving the two sides of the market further and further apart? And there's a lot of words for this. I decided on the deplorables as it was the cleanest. Now, if the spread gets wider, it creates an opportunity for people to play the spread. So let's say, for example, with a 20-tick spread, you could, for example, offer, say, 55.50 and bid 55.30. You'd stand to get a 20-tick profit if your orders got filled. And that's where these deplorables come in. With a 20-tick spread, sure, you stand to make a 20-tick profit playing the spread. But what if somebody is willing to jump in front of you and take an 18-tick spread? All they have to do is put in a 1 tick higher bid or a 1 tick lower offer, and now the spread's 18 ticks. Now, during the days of the trading floors, this jumping in front was known as diming the market. So if the spread was 2 ticks, someone could dime the market and jump to the front on one side, narrowing the spread to 1 tick. In some markets, doing this repeatedly would see you downstairs past the no fighting line outside the CME building, being forcefully re-educated in the face by a fellow trader. How much they must miss the good old days, eh? Now, in most electronic markets, the spread will rarely widen for long before somebody jumps in the gap. So whoever jumps in just got first place in the queue and will be filled against the next market order that comes along. And yes, that is a simplification. I know there are different kinds of queue. Now, you can try this yourself on options with wider spreads and low activity. So you can jump in front of the spread and you'll see within a few seconds, somebody will jump in front of you, the market maker, who is no doubt cursing you at the same time. So what's the effect of the spread narrowing? Well, let's say the inside bid is 55.50 and the inside offer is 55.55. We know that the next market sell order will eat at the remaining bids at 55.50. So somebody comes in and narrows the spread with the bid at 55.51. So market orders now have to eat the bids at 55.51, one price higher. So the offer side didn't move, but the bid side moved up 1 tick, closing the gap. And the bids can continue to rise that way until they reach 1 tick below the lowest offer, and that's as high as the bids can go. So diming can move the markets together, but it can't push them apart. It's like a magnet between the bids and the offers. The upshot is that while we do have two independent interactions, one up and one down, the filling of the spread is the glue that stops these two interactions occurring further and further apart. So we have an up interaction and a down interaction. We have the deplorables filling in any gap between them, gluing them together and kind of making it a tug of war. But it's a tug of war where there is also a potential stopping force that could pop up at any moment. So in this case, we can see a tug of war between buy market orders and sell market orders. And a few ticks up, we can see a really large limit orders. If that's real, in other words, they don't pull out of the way when we get there, it might be too much for the buy market orders to consume. They might not be able to eat through all that liquidity. So balance of trade between buy and sell market orders is part of the picture. All other things being equal, the side with the most market orders will see the market move their way. And a lot of the time, that's all you see going on in the order flow. So we may see the majority side being buy market orders for hours and hours and the market moving up. Later on, we'll see the balance change to the sell side and then the market moves down, ebb and flow. Other times, the stopping force will be in effect. It may be visible with the bids and offers being displayed, or it might be invisible with an iceberg order. It may even be fake, in which case it disappears as price approaches it. So the stopping force will always be evident in the number of contracts executed at each price. For example, it may take an average of 300 contracts to eat through each price on the way up, but suddenly it's taking 500, then 900, then 2,000 contracts, and that's the stopping force getting stronger. So how does this appear outside of an 80s arcade game? Well, here's a snapshot of the jigsaw depth and sales at the time I was writing this. So we can see the four forces interacting. We can see the weak stopping force of the bids here and the offers here. And we can see the strong moving force of the sell market orders and the buy market orders here. Now we can see that the bids and offers are all pretty much around the same size, 230, 250. We have a little anomaly up here. And that's quite normal. Now price had moved up to 55.50 and then rolled back down, and now we're at 54.75. Now note that these market order numbers here are not cumulative, okay? They do reset as we go down, and we'll cover that in another webinar. Now on the way up, we can see we had more buy market orders here than sell market orders here, and that's pretty much as we'd expect. We can also see it took 21, then 45, then 87, then 68 contracts to trade to successfully move up through each level. Then up here at 55.50, we see 320 contracts trade, and there were no more moves up. And that is the stopping force in action. The buy market orders continued, but the offers stayed firm and absorbed the buying. And now we see the market moving down, and we see balance of trade has flipped to the sell side. Okay, we see more sell market orders. And this highlights why you need to keep an eye on all four forces and not just the balance of trade with something like cumulative delta. Now this is the same activity, but a visual historical perspective with Jigsaw Auction Vista. Now the horizontal blue and red areas are the bids and offers, with the lighter colours being the stronger bids and offers. Now we can see there really aren't any significant areas of liquidity around the prices we're trading. We can see below, yes, we have some higher buy side liquidity here, and up here we have some higher sell side liquidity, but nothing around where we're trading. Now what we can see as we get to the top of this move is this blue-red circle, and it shows that an abnormally large amount of trade for the time of day occurred there. It was mostly buying, and price didn't move up from that point. The weak force isn't showing their hand, but they're adding more limit orders as buyers continue buying. The limit orders are effectively hiding. Okay? Now there are many different order flow tools. Each shows a different perspective of the same information. And this is just to give you an idea of how it appears on Jigsaw. And that's all we'll look at today. Understanding the mechanics of price movement is the first step towards benefiting from order flow. Now the next step isn't necessarily more theory, although we will follow up with another webinar that goes into more detail about the various ways you can use this information. But there is no substitute for practical experience, and for that I recommend you take a look at the trading drills that are part of Jigsaw's Order Flow Foundation course, a free course with over 15 hours of video instruction covering all aspects of order flow analysis. But for now, let's go over any questions you might have.